Welcome back to the channel, everyone. Today we have some important updates for you regarding Social Security benefits that could have a big impact on your financial future. Whether you're planning for retirement or relying on Social Security now, this information is vital. We're going to dive into the most recent estimates for the upcoming benefit rise, talking about a crucial problem that many retirees encounter. That is, regretting the choice to start receiving benefits earlier than planned, and what you can do about it. However, before we get into the specifics, if you found this video useful, please give it a thumbs up and think about subscribing. To be up to date on everything, let's get right to the point of today's video. Lately, we received fresh inflation figures. While they're not particularly cause for celebration, they do provide us with a better understanding of the situation. Social Security, your assistance enables us to reach more individuals who want this vital information. Notion of the next cost of living adjustment to anticipate. Despite some false headlines indicating a large rise this year, COLA for Social Security. As you may know, these adjustments are important since they affect how much more you'll receive in your monthly benefits, starting in January 2025. June, the Senior Citizens League reports that the next scheduled rise won't occur until January 2025. As a result, we should anticipate a COLA of roughly 2.6% next year, down from the 3.2% adjustment we witnessed in 2023. This slight increase is alarming, especially in light of the fact that many seniors believed the adjustments made the previous year didn't keep up with their actual living expenses. According to a survey by the Senior Citizens League, 69% of respondents said their home expenses are rising more quickly than their Social Security benefits. The major offenders in this case are the costs of food and housing. Due to the gap between benefits and actual living expenses, a large number of retirees are having financial difficulties and are turning to food pantries and emergency savings. One of the more concerning conclusions is that the COLA's inability to keep up with inflation may have cumulative, long-term implications. In this case, your monthly Social Security check of $11,000 is all you receive upon retirement. However, if inflation increases even a little each year, the difference between your actual benefit and what you require to maintain your level of living will increase over time. This deficit might mount up to, given this circumstance, some retirees are deciding to return to work, even if it means taking on jobs that are physically demanding or less pleasant. They're doing whatever it takes to bridge the gap. Up to tens of thousands of dollars over a 25-30-year retirement between their living expenditures and their Social Security benefits. Pausing Social Security payments in order to perhaps receive a bigger payment later on is a calculated decision that needs serious thought. Now let's speak about how to go through this process and the things to think about first. Learn more about the two main ways to halt payments and withdraw your benefit claim. If, soon after beginning your benefits, you decide that this was a terrible idea, you can withdraw your benefit application. However, you must submit Form SSA 521 to the Social Security Administration. To successfully withdraw your application, you must fulfill two essential requirements. First, you must act within a year of your initial approval. Second, you must be able to reimburse all benefits you have received, including any payments made to family members and any Medicare premiums deducted from your income, your bank statements. If these circumstances apply to you, withdrawing your application can effectively reset your Social Security start date, enabling you to reapply later in life and benefit from delayed retirement credits, which can raise your income by up to 8% annually until you reach retirement age. You become 70 years old. If you can afford to postpone Social Security benefits in order to optimize your future benefits, and you have additional sources of income, this tactic may be especially helpful. The alternative is to halt your Social Security income. You can use this if you've completed your entire retirement age, but they haven't reached 70 yet. When you suspend your benefits, you no longer receive checks in the mail, but instead accrue delayed retirement credits, which boost your final monthly payment. This increase is calculated at a rate of 23% per month that you suspend your benefits for an annual increase of 8%. One major benefit of suspending benefits rather than withdrawing your application is that you are not required to repay the benefits you have already received. However, it's crucial to understand that suspending benefits doesn't erase any prior eligibility. Your benefits will automatically resume at age 70 unless you choose to restart. Reduction you suffered by making early claims. It just stops them to make room for later retirement credits. Let's now go into greater depth about the ramifications of these tactics. Delaying benefits can be an effective strategy to improve your long-term financial security because it results in large monthly checks. Delaying benefits has some disadvantages. It can greatly improve your financial stability, especially if you plan to live longer than average. This is especially true given the rising costs of health care and long-term care, which are major concerns for many retirees. The main drawback is having to forgo income temporarily. This may not be possible for everyone, particularly if you don't have other sources that are sufficient to pay your needs. For this reason, the choice to postpone should be based on a thorough evaluation of your financial circumstances. To make an informed, consider life expectancy as other elements, including your health and family history. Although no one can precisely forecast how long they will live, it's important to think about your life expectancy, your family lifestyle, and state of health. All offer some direction. If you're in fantastic health, delaying benefits may make more sense if you are in good health and have a family history of longevity. On the other hand, it's preferable to begin getting benefits if you have significant health problems or a family history of shorter lifespans. Marital status is another crucial consideration for married couples. Extra techniques employed to optimize their advantage. For example, if one spouse applies for benefits while the other, this may lead to a combination of high future and income now. Moreover, if you're the survivor, survivor benefits may be a big factor in your decision making. It is important to think about the tax implications of your Social Security benefits, because depending on your overall income, a portion of your benefits may be subject to taxes. Higher earner delaying benefits can increase the survivor benefits available to your spouse, giving them greater financial security if you pass away first. Delaying Social Security benefits could help you manage your taxable income. It also makes sense to start benefits early if it helps you to your taxable income. If you have other sources of income that could put you in a higher tax rate, income more equitably over your retirement years. To help you with these decisions, financial planning tools and expert guidance can be immensely helpful. A lot of financial advisors employ advanced software to predict various situations and assist understanding the possible results of your decisions. These instruments may accommodate a range of, in addition to professional advice, there are a number of online calculators and resources by the Social Security Administration and other financial planning websites that can explore your options. Factors like inflation, investment returns, and changes in expenses over time that provide a more comprehensive picture of your financial future. Many situations, these tools assist you in estimating the effects of changes and strategies on your benefits and total retirement income. In addition, as we've discussed, COLAs adjust Social Security benefits for inflation. However, the adjustment may have an impact on your retirement income. Frequently fall behind real increases in living expenses, which implies that even with COLA, your purchasing power will gradually decrease. Having extra savings and investments in place, in addition to
and other sources of income can help reduce this risk and provide as a buffer against rising costs. Pensions can be a major factor in your financial security if you have retirement income. Accounts for retirement savings, extra income streams may be available through IRAs, 401ks, and other investments. Your reliance on Social Security and increasing your financial security achieved by diversifying income sources. Additionally, it's critical to take healthcare costs into account when budgeting for retirement. Medicare offers basic coverage, but it doesn't pay for everything. Premiums must be paid out of cash, and the cost of prospective long-term care can mount up quickly. It's essential for these expenses, use insurance or other methods to be sure that your retirement goals are derailed by healthcare costs. Rates for long-term care insurance might be substantial. Having coverage can offer financial security and peace of mind in the event that you require extended care, is an additional alternative.